Welcome back, everyone. This week, we're going to address and elaborate on a question that a person had about how I keep my money in SPAXX, which is the Fidelity Money Market Fund account, as opposed to other potential options, particularly in reference to USFR. This is going to be a longer video with multiple slides, and I'm going to address the question of which is better, and I'll answer that now, which is, I actually think USFR might be better. Now, I'll show you my developmental process and research process, which is going to extend this video, and things I have to go through and hiccups that occur as a consequence of finding different information on different sites. So this is going to be an in-depth video covering that. So with that out of the way, let's get things started. This chart sums it up well enough. Over a 3-year period, USFR on a $10,000 account has become a $10,541 account, as opposed to SPAXX, as I'm going to refer to it from here on out, has $10,441, which is to say that there's a $100 difference in performance. Now, if you have $10,000, maybe you don't care about $100, but understand this scales. So if you have a $100,000 account, then that's a $1,000 difference, and a $1 million account is a $10,000 difference. And on a percentage point, it outperformed, relatively speaking, by an additional 25%. So say you make $400 on a $10,000 account, and you make $500 on another $10,000 account, you could say that that other account, in the money that it generated, produced a 25% outperformance. And although when it's all said and done, they're still small numbers, it still matters because, as I emphasize on this channel, you really need to think of things in percentage terms as opposed to dollar terms. What we'll be covering: money market funds versus ETFs, the holdings of the two, the average annual total returns, expense ratios, yields paid, payout periods, other factors to consider like state tax, FDIC insurance versus SIPC insurance. We'll get into the weeds at the end and even in the middle and even at the beginning, because there's tons of weeds, because there's nothing simple, even though people say keep it simple. So the composition of SPAXX is what you see. And what I want to draw your attention to is the U.S. government repurchase agreements. You might know that as the repo rate. There's going to be multiple things I touch on that I'm not going to get into the weeds on, because I'm not trying to have this be a 2-hour discussion. So, U.S. government repurchase agreements. That's actually relevant from a tax consequence perspective, which we'll get into later. But notice that the U.S. Treasury bills only accounts for 19.24% as of 8/31/2023. USFR is all in treasuries, and they're floating rate notes. That's what the FRN stands for. So all treasuries in USFR and 20% treasuries in SPAXX. So that's the positioning of the two portfolios. I insist time and time again that the concepts in a statement are just as important, that the preconceived notions and implicit concepts in a statement are as important as the statement itself. So one's a money market fund. The SPAXX is a money market fund, not a money market account. So one's a money market fund, another one's an ETF. Okay, well, the thing is most people pretend like they know things when they don't know things. And just ask someone to draw a picture of a bicycle, and they'll probably get it wrong. Ask someone how a car works, and they'll say, well, you hit the gas pedal and it puts more fuel in. It's like, well, Does it put more fuel in, or does it balance out the ratio between fuel and air? And on it goes in life. And people act like they understand things better than they understand things. So you're like, oh yeah, my money in a money market account, money market funds, or money market fund is safe, blah, blah, blah. ETF is a stock you trade. I'm not going to get into the weeds as to all the differentiating factors between a money market fund and an ETF and so on and so forth. But there are relevant differences and implications of them. And I'm actually going to focus more on a money market fund because there's something important when it comes to money market funds. And that is that it's not FDIC insured. And a lot of people also conflate, because they don't know any better, between money market accounts and money market funds, and they're not the same thing. And that made me think of ADRs. And there's different levels of ADRs, just like Alibaba, the company. You can buy the stock on US listed stock exchanges. But what is Alibaba? Well, Alibaba is a variable interest entity, a VIE. Well, what does that mean? Well, we're not going to get into that today, but it's important that you actually know what you're getting into, or at least to be better educated than you once were before. And then so you have ADRs, and that ADR is a VIE, and so you're buying that on a US listed exchange, but what's the implications of that? Because at some point, maybe if something goes bankrupt, then they sell off the assets and return it to the debt holders and the shareholders. And if you're at that point, you've probably lost all your money anyway, because the debt holders are going to get all the money and you as a stockholder aren't. But there's still differences in significance in it all. So here's a screenshot. Links are in the description. There's going to be quite a few links of the Fidelity Government Money Market Fund. And we'll get into titles like Government Money Market Fund. What does government mean? You have to question the concepts in a statement as much as the statement itself. We'll touch upon the finer details of this, so we won't spend too much time. Wisdom Tree Floating Rate Treasury Fund. Okay, so let's start comparing them. The average annual total returns. Now, you'll have to keep in mind that SPAXX, which is the top one, is updated to the end of August, while USFR is only updated to the end of June. Seemingly, they have SPAXX has a monthly fact sheet, and then USFR has a quarterly fact sheet. So it would be better to do this come the beginning of October than otherwise. But so the year-to-date performance, we can't really pay attention to that. So we can look at the one-year returns. And then there's no whole other thing, just pre-tax returns versus after-tax returns, which we're going to ignore for the most part here today. So we'll compare 1 year on the SPAXX at 4.05%, and then the USFR net asset value returns 1 year, 4.05%. But if you go look at the 3-year and the 5-year, and USFR hasn't been around for 10 years, so there's no comparison, you can see that the USFR has outperformed, technically, the SPAXX. Why do I say technically? Because you could say it's a distinction without a difference, but that's only true if you don't have, if you're comparing it in dollar terms. On a percentage term basis, it's outperformed. So that right there should say, well, you should invest in USFR and not SPAXX. Now you could say, and I meant to start this in the introduction, why do I have SPAXX? I'll tell you why I have SPAXX. Because I haven't taken the time to research all the varying entities and mediums that I could use to express cash holdings. And I don't want to be bothered with it. And if that's the determining outcome of my portfolio performance, then I have a lot worse problems, which is probably more of a convenient excuse of being lazy than anything else. But I find that the returns I get on SPAXX is good enough. And there's an anchoring bias involved, because what I was getting at TD Ameritrade as opposed to Fidelity was a lot less. And SPAXX was a default setting. Fidelity just gave me that. I didn't choose it. So that's post hoc rationalization and saying it's good enough. And I kind of do actually believe it's good enough. But that's what post hoc rationalization is tricking myself into actually believing something. So we won't go down that rabbit hole. Expense ratios. SPAXX has a 0.42% expense ratio, and then USFR has a 0.15% expense ratio. So USFR wins again. Yield. SPAXX has a 4.98% yield. Let's go with distribution yield because that's the lowest one, so we'll conservatively use that one. USFR has a 5.15% yield. So USFR wins again. Payout periods. Maybe you want your money more frequently, or you don't care. Doesn't really matter. Now you'll see this will be one of the hiccups people have when it comes to researching things and using different sites for trying to find the same information, keep constant their comparisons, control for variables. The best I can tell, USFR has a monthly distribution period. Now, this is an interesting thing because you'll see it highlighted at the very bottom here. So the last slide shows monthly distributions, and FRNs, which is what it is, floating rate notes. Here at the very end it says FRNs pay interest rates quarterly until maturity. Well, that would suggest every 3 months. So how does it have a distribution every month if FRNs, which USFR is, shows monthly distributions? And my question is I don't know and I don't care, because even though we'll go through these slides quick enough, this took me half a day to make this video, I would say, and sometimes you just have to call it quits. The problem is you want to answer a simple question like this compared to that, which is better? And then you have to go into all the preconceived notions of what this is, and what's an ETF, and what's a money market fund, and what's a money market account, and what's the differentiating things, and what's the different risks and rewards, and how do they compare? And you really end up going down a rabbit hole, because then you say, well, what's a floating rate note? And then just on and on it goes. So best I can tell, USFR pays monthly. So here's another hiccup I have, or had. SPAXX. How often does it pay? Well, the best I can tell from the information I gathered, and not all of it's in this video, is it too pays monthly. Now this is an interesting chart, which is every payout is zero. Everything's zero. Zero, zero. Like, I don't know how they account for this, because they try to keep the NAV at 1. And I don't know. I really don't know. But I found it interesting. I wanted to include this because, maybe I make a video that's seemingly succinct enough, but what it doesn't show, what I've never shown in any of my videos, is the unanswered questions that are left behind after developing a thesis and belief and executing on that idea. Because there's much information that I come across. Like one time I was reading about how much uranium was produced per annum, and a very reputable source miswrote, to the best of my ability, and I can't quite remember the details, but it, by an order of magnitude, either underrepresented or overrepresented the uranium. So then I had to go to other sites to see what they said, to compare and contrast, and plus I had my own idea of how much uranium was produced, and so on and so forth. I spent an hour going down this rabbit hole because the site that I visited misspoke on a couple of things, like primary production versus secondary production, and how Rio Tinto has some secondary byproduct of uranium, and then it misrepresented how much that was as a percentage of the overall uranium market, which is kind of relevant because they're more price agnostic when it's secondary supply that they don't really care about, and they're willing to take more of a haircut on the price or get rid of it at any price because money's money and they don't care about it to begin with. They're at something dam. And so, unanswered question. What is this about? Why is it represented this way? I don't know. Anyway, dividend payout. So this is another thing. So if you see dividend payout history, then it says amount, 0.004. And I'm like, is that 0.004 cents? Because if you go up, let's go back, right here, you'll notice that USFR shows total distribution as 0.22 cents. Now, if we go here, the amount, is that supposed to be in cents? Now, what's interesting is, I can't remember, I did the math, however, USFR trades at roughly $50 a share. If you do 50 divided by, I can't remember if I divided and multiplied, whatever I did, by 0.004, then you realize that it's about 22 cents, which is to say that it seemingly is representing the amount as a percentage term as opposed to a dollar denominated term. So different representations of the same thing. It's the same difference, but it's represented differently. And if you don't account and control for the variables, then you might get a false impression. So that's just more work. Anyway, to sum this portion up, that's to say that they both pay roughly the same, even though USFR pays more, and they're both monthly dividend payouts. So money market accounts versus money market funds. The emphasis I want to note on this is that a money market fund is an investment product, not a deposit product, and therefore can't receive FDIC coverage. Okay, so maybe you don't know much. Maybe you're an unsophisticated investor or, whatever. You might say, wow, it doesn't have FDIC coverage. I don't want any part of this because SPAXX is a money market fund, and this is telling me that my money market fund isn't covered by FDIC coverage. Therefore, why would I take that risk? Well, that first of all presupposes that USFR is FDIC insured, and it also ignores SIPC coverage. So, we're not going to talk about what FDIC is versus SIPC. What I want to note here is what fidelity accounts are covered under SIPC. Well, it includes money market funds held in brokerage accounts. So now you might think to yourself, oh, okay, good. It's not FDIC insured, but it's SIPC insured. So I'm good to go. But yet again, good to go on what level of analysis? Because that presupposes that you actually know what SIPC and FDIC coverage, covers. And one of the links in the description is to, I believe, a Reddit page in which someone was talking about some money market fund of theirs and how it's SIPC covered, but that doesn't necessarily mean what you think. And this is the response to that. And I'll touch upon a few of the points. It starts off with saying, this is correct. SIPC would not cover if the money market fund broke the buck, which is a term, by the way, a money market fund breaking the buck because the NAV, as I noted earlier, pins to $1. So if it breaks the buck, then a buck is $1, and therefore it violates that NAV. So if it does break the buck, that would be treated as I invested in stock ABC and it lost 20% of its value, which SIPC does not cover value loss of a stock. That's not what it's there for. He goes on to note, however, only 2 money market funds in history broke the buck, lost value. And that's kind of relevant because you could say, what's the risk to this? And you could say a risk to a money market fund is that it breaks the buck. But then the next question is what's the probability of that? And then you can go on and use historical precedents to establish the probability of something. Of course, the past isn't a predictor of the future, but it is something that you can rely on to gauge the probability of future events. So he goes on to say, the first was in the 1980s and was a very small fund of no importance. I honestly do not know much about it. However, in 2008, the Reserve Primary Fund held some 50% of its holdings in corporate paper. Also, it had about 1.5% of Lehman corporate paper, and Lehman went bust. In the end, the fund paid out 0.991 for every $1, a loss of less than 1%. Note, if you would have invested $1 million 4 months before it went bust, you would have been paid out over $1 million during liquidation, as you would have earned at least 3 months of interest. What would have covered those losses? In theory, if you invested $1 million 2 days before it went bust, you would have been paid out $991,000. Okay, so that's important too. So as he noted, this particular money market fund had 50% of its holdings in corporate paper. So yet again, you have to question the concepts in a statement as much as the statement itself. I have this in the money market fund. Well, what kind of money market fund? There's a lot of different kinds of money market funds. So you can't, with hasty generalization, conflate categories and paint with a broad brush. You have to differentiate. So you could say, I'm not going to put, in present day, you could say, I'm not going to put my money in a money market fund because back in 2008, a money market fund broke the buck. And that's not a risk I'm willing to take. But then you could say, but that money market fund that did break the buck had a disproportionate amount of its money or of the investments in corporate bonds as opposed to treasury bonds. So that's kind of relevant, don't you think? And of course, the yield of that money market fund, I'm sure, was higher than other money market funds as a consequence of having corporate debt. And corporate debt, yet again, is a class of its own. What kind of corporate debt? What's the credit rating of the corporate debt? And on it goes. So beware of the, okay, so on to the next point. Beware of the hidden tax of money market funds. Link in the description. This is essentially to say that depending upon the money market fund you have determines tax implications that you owe. So as I said at the beginning of this video, if the repo rate, the repurchase agreements that I noted and highlighted are now relevant. Why? Because they're taxed at a state level, as opposed to government treasuries that are taxed at a federal level and not at a state level. So you have to factor that in. That's the difference between pre-tax and post-tax returns, which at times can be quite relevant and is something that you need to consider. That's another multifactorial, multivariable equation that you have to solve for when you decide to invest in something. Because to say, what's the total returns is like total returns on what level of analysis? You hear about this all the time with people speaking derogatorily in regards to hedge funds about, what's the return? Return on what level of analysis? But before the 2 and 20s charged or after? Because why do you care what the returns are pre 2 and 20? Why would you? It doesn't make sense. It doesn't make sense. So, but yet again, so money market funds that have repurchase agreements, you as an investor are in all likelihood having to pay state tax on that, but not necessarily, because there's some states that don't have state tax. Florida is one of those states. And I believe Texas is another one of those states. And then state tax is different. In my state, I think it's 4.5% is state tax. You go to California, I think it's 10 or 12%. So that also makes a difference. And also, by the way, is another win for USFR because it doesn't have repurchase agreements. So, by the way, as I noted, this is a conversation about SPAXX versus USFR, not money market funds versus USFR, or money market funds against the entire aggregate of any individual treasury bond ETF. This is a very specific, and people like to extrapolate linearly and make hasty generalizations, which you shouldn't do. But keep in mind, this is a SPAXX versus USFR. So this is another win for USFR because it doesn't have repurchase agreements, therefore you don't have to worry about state taxes, which diminishes your total returns post-tax. So we're kind of done with the bulk of that. USFR wins. I don't see how it doesn't. So then this got me thinking, like, oh, well, maybe I could put it in a different money market fund. You could say, well, why not just put it in USFR? But yet again, this is strictly a SPAXX versus USFR, not a USFR versus the entire domain and world of everything else. So I naturally thought, well, maybe I could change my money market fund. Now this is funny. Fidelity Treasury Money Market Fund. Now you would think, Treasury Money Market Fund. Okay, I could get that because it now has treasuries, not government. Remember the SPAXX is, I can't remember what it's called, government money market fund. Okay, well that keeps things pretty open-ended. But this says Treasury Money Market Fund. Well, this is what I mean by questioning the concepts in a statement as much as a statement itself. Because if you thought that treasury meant treasury, you'd be wrong. Because as this shows, U.S. Treasury bills, 22%. Interestingly enough, this one, the one that says treasury, has more repurchase agreements than the one that says government. You know, government's vague, ambiguous. You can really put a lot into that placeholder word. But this one legitimately says treasury, and you'd be mistaken. It actually has less treasuries, which is classic. And so things aren't always what they seem. And this made me think of something tangentially associated, which is the iShares ESG Aware MSCI USA ETF from BlackRock. So if you're under the influence of ESG and want to invest in good companies, then, which is really to say to not invest in bad companies by your own definitions and ideology, not mine. So I'm using their language, not my own. You might buy ESGU. You believe in ESG, I'm going to buy ESGU. Well, then you come to find out that what moves the index in large enough part, like, is really a closet indexer. And the expense ratio is 0.15%. And you might compare it to, well, I didn't make this slide, my apologies. So you can compare it to the BlackRock S&P 500 index, and that has an expense ratio of 0.09%, as well as the Magnificent Seven, as they call them: Apple, Microsoft, Amazon, Nvidia, Google, Tesla, and Meta. It's kind of interesting because once you dig into this, and I'm going to go on a little side tangent here, is if you find out that you're paying more to get essentially the same return. So fair enough, like, you got to make sacrifices for your beliefs sometimes. So if you really believe in ESG, then you're more than willing to pay more for it and get less return for it. And fair enough. Like, that's your belief. You're like, well, I want above bond returns, and I don't want to invest in evil companies. Of course, you're ignoring all these things like, countries that these companies might operate in, and the labor conditions in, I don't know, China that might make some of the chips and components for some of these companies that might have labor right infringements and so on and so forth. But that, let's not pay attention to that, because that's a derivative. That's not immediate. If I sell you alcohol or tobacco, it's in your face: bad, evil, not good. But if I sell you something that is technologically relevant and important and helps the efficiency of the world, even though I might use child labor to make the product. Well, that's one derivative detached. People talk about solar panels, but then they don't talk about how the solar panels are made in Uyghur concentration camps in West China. Or people want to talk about ESG and then buy US treasuries. But it's like, it's kind of funny, because doesn't the United States fund China and or buy Chinese treasuries? And doesn't some of that inflow of money might fund the Uyghur camps that use forced labor and forced sterilization and so on and so forth towards these Uyghurs? But you don't want to think too much about it. So, or somebody who says they're ESG and then they, in their 401k, have invested in the S&P 500. And it's like, well, why would you be in the S&P 500? They have tobacco companies. Like, you should be buying an ESGU, spending more money for less returns and compounding that slower for your 401k. But yet again, those are iterations deep, and people don't want to think that much for very good reason, because, well, your ego investments and ideologies become undermined and questioned, and then you have to think, and people don't like to think, and they don't like to have their beliefs questioned, so they don't. But I digress. So then I looked at this one, Fidelity Treasury Only Money Market Fund. It reminds me of cheese. I was going to put a slide in here in a link. I believe for cheese to be classified as cheese, it only has to be 51% actual cheese. Which is quite funny, that a lot of things get a pass like that. It only has to, the majority of it, and majority, statistically speaking, is 50.1%. That's the majority. Just the majority of something has to be something to be called that something, which is, quite interesting. If I sold you a car and 49% of it was just styrofoam, you would say this isn't a car. And there's about 1 million examples that you can think that way, but somehow people like to turn a blind eye. Like, people say made with real cheese. It's like, there is no other kind of cheese. Cheese is real. Therefore, if it's not real cheese, then it isn't cheese. But, well, people like to be, speak perversely, chronically. So the Fidelity Treasury Only, apparently you need the word only to emphasize that it is what the prefix of the Treasury word means. So if I tell you it's Treasury Market Money Fund, then I guess I can invest in a bunch of Chinese real estate companies, because I didn't say Treasury Only. The investment community and the world in general. So the Fidelity Treasury Only Money Market Fund, which I should have compared the returns of this versus the USFR, but I did not, so my apologies. The Fidelity Treasury Only Money Market Fund might be something I'd be interested in pursuing and investigating. Notice 0 repurchase agreements. And then I didn't investigate any further as to what 14% of net other assets means, but it's closer than it otherwise would be. So, you might say, okay, I've spent most of this time talking about SPAXX, determined so far that USFR would be a better return, better yield. What's the risk? And, I don't know, outside of basic ETF risks, I kind of thought that, if the stock market got halted, you would not be able to sell. Like September 11th, stock market was halted for 4 days, and there's other times that the stock market is halted historically. It's not too common of occurrence, but it does occur. And I thought that, well, maybe if the stock market's halted, then you're not going to be able to sell the ETF, which means your money's just gone. It's locked up. You can't access it. As opposed to a bank. If some outlier event occurs, the stock market closes, your bank's still open, so that is actually a benefit. You could say a benefit of getting no yield on a checking account, having cash, is that if something catastrophic occurs in the stock market and markets in general get closed, maybe you can still withdraw the money out of the bank, out of the ATM. So there's that outlier, which you shouldn't dismiss, but weigh it proportionately. And then I got to thinking about good faith violations. So maybe you try to sell some USFR to fund a purchase of other stocks, and then you sell those stocks and then try to buy the USFR because maybe you were trying to do a day trade and it worked against you, or maybe it worked for you and then you sold, and then you try to intraday get back into USFR. I suspect at that point you're going to run into problems, but that isn't to say that you will not run into problems with SPAXX either, because in the final link in the description, if you do not know about good faith violation, then probably read up on that. And then this is a little chat between two people about capital gains and capital loss. So I'll just let you read this. I don't need to read it for you. It should be large enough that you, even if you have a phone, you should be able to read this on your phone, this little conversation. So I will note, though, that there's another option, seemingly called TFLO, that is quite similar to USFR. I don't know. That's the impression I get, not just from this, but a few other encounters I had on the internet. It seems like TFLO and USFR are similar in a lot of ways. And even if you do sell your USFR, you could buy the TFLO and trade that for a while and wait the 30 days before you buy back the USFR if that is the preferred index, if this is a necessary thing due to your own particular situation. So that's something to be mindful of. And then the third thing I note is yield curve inversion, which is that right now the floating rate notes or short-dated treasuries is my impression, and due to the current yield curve inversion, shorter dated notes are yielding more than longer dated notes. So if that reverts back, then you might want to think of something else. But under the current state of the market, the USFR seems to be the way to go. You could say, so will you be seeing me own USFR in the future? And, I hate to be this person because it's called being a hypocrite and is a declaration of one's lethargy, but I'm not going to. Do I have a good reason? Not really. Not yet, at least. Not that I've pointed out in this video. I just don't like... I've looked at bond and treasury bond ETFs before, using them instead of just having a cash balance. And I've actually looked at money market funds as well, and I don't know, something about it doesn't sit right with me. And I don't know what that is. And honestly, like I said, this video took me half a day to make. And I'm not willing to allocate the time and energy, which are crucial resources to all of us as people, to try to clip a fractional percent more. Especially when I've gotten the cream of the crop. Just going from Fidelity or from TD Ameritrade to Fidelity, I've massively bumped up the yield I get on my cash. And I'm not interested in squeezing out that last bit, nor am I interested in paying attention to the bond markets beyond what I do, concerned about the yields breaking out. And I'm just not going to do it. And I would say that's more of a emotionally based decision that I'm post hoc rationalizing. You would think that if I'm homo economicus, that I, as a rational agent, would maximize my return. And here I am telling you I won't because of my feelings. So maybe this is the first time in life you can pin me with being an emotional creature, because that's the best explanation I have to why I won't. But interestingly enough, I am interested in this other treasury-only money market fund. And you can say, well, why would I want to? I don't know. It seems like I don't like the T+2 settlement period. I don't like how if I did want to do some day trading and or buy back the USFR after selling the USFR to liquidate it to buy something short-term, I don't plan on doing that. But as you might know, or as anyone who watches this channel might know, sometimes I do put trades in. And sometimes I hold them for a few days, at best a few weeks, and I don't want to have to think about those settlement periods. And you could say, would that be a net negative or positive over the long term? And I would say it'd be a net neutral and doesn't really matter. And then I don't like the idea of the market being closed down, with the precipice of the Ukraine war and China talking about Taiwan from time to time. That low probability, high magnitude occurrence of the markets getting closed down, I might want to take cash out of my account. And if the ETF can't trade, then I just don't like that. I just don't like that. So with that out of the way, that's my summation of all of this. USFR, because the question was, what are the risks to USFR? I don't know. I mean, outside of just the ordinary risks of, you could say interest rate risk and credit risk. The credit risk you're taking is the U.S. government. And I'm not sure how these things would trade if the U.S. defaults. It'd be interesting to see how these things traded when, and I would have included this if I thought of it at the time, when the government has, quote unquote, defaulted on its debt by not raising the debt ceiling limit. But there's still runoff periods for that too. So, credit risk and interest rate risk, we covered that about the yield curve inversion. If the United States defaults on its obligations and loans and debts, then I suspect we have other things to worry about more. And I just don't really see any of the risks outside of the ordinary risks. And an ordinary risk shouldn't be something to dismiss just because you're conditioned and habituated and desensitized to it. I find it funny when people say risk-free interest, or like risk-free rate. The risk-free rate is, let's just 5%. I've always found that funny. Like, well, if real inflation is at 7%, not the CPI nonsense, but real inflation is 7%, and you buy something yielding 5%, and that's risk-free. It's like a guaranteed 2% haircut on your money per annum is risk-free. Like, that's, but that's how people talk and conduct themselves and think. And most people think in nominal terms instead of real terms. And if interest rates on your bank account went from 0% to 5%, although inflation's at 7%, you feel richer. Just like if you get a 6% inflation in an 8% inflationary environment, you feel richer, even though you're actually poorer. And that's how people act. And if you sit down and explain it to them and tell them that that's how they behave and they're foolish for behaving that way, then they'll viscerally argue with you. And maybe they might even say you're right, but they'll continue to say the same nonsense. Let me give you an example of that. Bill, we're pretty much done here, so if you don't want to listen, you don't have to. I remember when gas was really cheap in the past few years, and then it went from $2 to $3. No one really said anything. And then I remember when it went from $3 to $4, a lot of people started complaining. And I thought that was so interesting. Like, from $2 to $3 is a $1 increase of 50%. But from $3 to $4 is a $1 increase of 33%. So the rate of change and has slowed, and the same dollar denominated amount is the same, yet they're complaining. And you could say, well, why are they complaining? Because there is an accumulative impact to their wallet. But what's interesting is that's not the reason they quoted. They didn't say, I could take the first dollar raise without affecting my quality of life, but the subsequent dollar raise is now diminishing my quality of life. That was the breaking point, that additional dollar. That was the tipping point. That was the phase shift. Not a single person said this. And I surveyed numerous people. Because once I heard enough people say it, I then started asking people who didn't say that and kind of goaded them and prompted them with a leading question of sorts. Like, how do you feel about gas going from $3 to $4? Kind of those kinds of questions. And what they cited was that it's too expensive. It's too much. It used to be such and such. So there was an anchoring bias there. They were locked into what it was instead of the rate of change or the absolute addition. And then I would say things like, well, say you use 2 gallons a day, 7 days a week. That's 14 gallons a week. Okay, so it's an additional $1. So that's $14. You're telling me, and I would say this to people, so you're telling me that $14 is the make or break for you and your quality of life? Like, as a fraction of your income, call it $500. As a fraction of, so $14 out of $100 is 14%. Like we're talking a percent, a 2%. And a lot of people make a lot more than $500, $1,000. It's like 0.14%. Like, it doesn't really matter. So cumulatively, from $2 to $4, you're paying an extra $28 a week. Like, you're telling me that the make or break quality of difference in your life is $28? Like your HBO subscription, the cup of coffee that you get, just on and on. It's like, really, you can't trim $28? And the answer is some people can't. A lot of people can't. Millions of people can't. But I wasn't talking to those millions of people. I'm talking to the millions of people who buy dumb stuff all the time, take vacations, the middle class, if you will, lifestyle, where they could afford $28. And it's just interesting. It was a unthought, emotional, psychological tipping point for them that they gave zero consideration to, but they really tried their best to post hoc rationalize. And they still wouldn't cede ground on the topic. And that's because normally, if you could say, well, why? Why did they not cede ground? Why did they not say, oh, well, I guess it really doesn't matter? Not yet, at least. The accumulation point hasn't hit a tipping point, or it's the same dollar amount and a smaller percentage. And the reason is once you start digging, it's because it's attached to an ideological narrative and a preconceived notion and their ego-invested beliefs. And it goes something like, that oil cartel, greedy bastards, and then, well, why does that matter? How is that an ego-invested belief? Because they're virtuous. Because they have identified an evil villain oppressing and suppressing them. And then they're anti-evil villain, which by default must make them a good person, right? And therefore, that's where the ego-invested belief comes in. I object to this rise in fuel because I'm opposed to an evil force, and that makes me a good person. That's the line of logic. Now, of course, none of this is a conscious thought, but this is how it plays out time and time again. And that's also important because, as I noted at the beginning of this video, in decision-making processes and going down the rabbit hole and all the tangential associations that come along with it, you could just be like, oh, they're irrational, and that's why they're concerned about an additional rise of $1 per gallon. But if you kept digging, you'd come to realize that they're an ideological bigot who believes in a constrained narrative at the exclusion of other information because they refuse to control variables and keep constant their comparisons, and that they're willfully blind. And that's the reason why they're upset about $1 increase in gas. At least some people. So, with that said, I'm pretty much done talking here, but weekly performance, I don't really have anything to say to this other than I think URNM, the Sprout Uranium Miners ETF, went up like 11% this week, which is pretty awesome. This really isn't a uranium channel. My best views by far are uranium videos, which perversely incentivize me to make this a uranium channel, and probably as a growing small channel that only puts out 1 week of video, I probably should wisen up and play the game and put out a lot of uranium content. But I don't know. I myself am ideologically opposed to that because I think there's a lot more going on in the world, and I kind of get bored with things. It's like, yeah, it's working. It's working better than I thought, and it's pretty much been stale for most of the year, but now it's ripping, and the fundamental thesis hasn't changed, and more eyes are being drawn to it because of price movement. It's like, yes, that's the things that happen. That's the abstract template that overlays such matters and phenomenon. It's like, I'd rather talk about that, but you got to stay grounded in reality because people don't want to listen to that nonsense. So even though it's everything that's necessary to make sense. But here we are. So, yeah. I was going to actually buy more YPF, but it hit the 200-day moving average. I was down at 1.16, 17% on the week. And I was going to buy it right when it bounced off the 200-day moving average. But due to, I don't know, cash balances being tied up over something, I'm not really sure, honestly, why or how, I was unable to do it without actually making that cash infraction, whatever a few slides ago that I was talking about, the T+2 settlement period. I'm not really sure what happened, but I was unable to buy the dip, or that dip at least, as it has bounced back, call it roughly 6%. So that kind of sucks. Other than that, I'm engaging in multiple verbal disfluencies by saying so that kind of informs me that I'm done here. So thank you for watching, and until next time.